Hello and welcome in this tutorial on how to use the optimal crypto portfolio allocation financial model template. This template will allow you to select the optimal allocation among three financial assets. And in the inputs tab, you will be able to select the currency that you want to use, the last monthly returns available. So here you will be asked to enter 60 months of returns, which is 5 years. And by selecting the last year available that you have, then the model will calculate when you should start. So in this case, if the last monthly returns available are June 2024, then you will need to start inputting monthly returns in July 19. And then the three assets that you want to analyze, in this case, BTC, SPX, and AGG, and then the risk-free rate. Then you add the close price for the given months, and the model will calculate the returns for each one of the assets that you want to analyze. Then you select the allocations. The third one is automatically allocated to account for 100%. If it is negative, it might be negative because it also consider leverage and shorting. So you select the allocations and the mean return will be calculated, variance, standard deviation, Sharpe ratio. And then by scrolling down, you will be able to see, so the star will show you which allocation represents the minimum variance portfolio, so the portfolio that minimizes the standard deviation, and the allocation that maximizes the Sharpe ratio, meaning what the optimal portfolio is. And then scrolling down further, you can see the analyzed arithmetic mean return for the assets, annualized variance, annualized standard deviation, and then the correlation. And then scrolling down, again, you will be able to see which portfolio, so what allocation of portfolios is represents the minimum variance portfolio and the optimal portfolio, what the expected return and expected standard deviation are for those portfolios. And then you will be able also to see the chart for the risk reward allocation of the different portfolios, and also the BTC allocation in this case, so the first asset allocation against the mean return, standard deviation, and Sharpe ratios for the different portfolio allocations.